Hi everyone, so welcome to the stream today, Brown Week, as we continue with our discussion for the November 2025 examination. Today's discussion, we're focusing on public sector to look at the way we prepare the financial statement in the public sector, and most importantly, how we apply the IPSAS principle when it comes to the public sector accounting and finance examination. So let me bring up my screen real quick and let's get excited into the discussion. Remember that when it comes to public sector accounting and finance, the question one in the exam hall is going to be on the preparation of the financial statement. And the preparation of the financial statement is going to be centering around whether we are preparing the financial statement on the consolidated fund, that is from the central government perspective, or from a covered entity perspective, and that could be a ministry, a department, an agency, a metropolitan, municipal, or a district assembly, something like that, or other forms of covered entities. And so preparation of financial statements, very important there. You must understand that. Now, in order for us to prepare the financial statement, there are a number of IPSAS that we have to be mindful of, like IPSAS 23, revenue from non-exchange transaction, IPSAS 9, revenue from exchange transaction, IPSAS 17, property, plant, and equipment. You got to be mindful also of, in some cases, IPSAS 12, that is inventories. Okay, then we can talk about IPSAS 19, provisions, contingent liabilities, contingent assets. And so that question two area, to be able to thrive in that question two area, you may have to call on the principles in respect of these IPSAS for starters before you can then go in and then be able to answer the questions there. And certainly in addition to these IPSAS, the key topic that will really help you to excel in this preparation of financial statements, and by extension, the entire public sector accounting and finance examination, is the topic in respect of revenue management and expenditure control. So this topic is central because this is going to help you to have an understanding of what is going on when it comes to sources of revenue to the covered entities, sources of revenue to the central government, sources of revenue to the various entities, as well as the expenditure classification. And that is important, and its accounting is very crucial because that is what can position you or put you in the position so you can go into the exam hall, write the exam with confidence, and most importantly, pass the examination. So that question one area, the preparation of the financial statement for public sector entity, all these IPSAS, we must know about them because that is how we're going to be applying it. Then certainly question two is going to be the IPSAS dedicated. So just like financial reporting, now in public sector, you're going to have a dedicated question on the international public sector accounting standards. And what we've seen the examiner doing over the last 3 examination dates in this new syllabus is bringing 2 or 3 IPSAS that you have to be mindful of. And so as you are going into the exam hall, the question 2 area, there will be some IPSAS there. And so in addition to the ones that are directly going to be reflecting in the preparation of the financial performance and position of the entity, we have to also be mindful of the fact that we will have dedicated IPSAS questions, and we should be in the position to be able to provide the answer at the end of the day. So that is what we want to look at here and focus back on the question 1, preparation of financial statement. And we are looking at ICAG July 2024 past question, ICAG July 2024 public sector, and we are looking at question number 2 of that particular date. Let's look at a requirement here. For 17 marks, the examiner asks students to prepare in accordance with the International Public Sector Accounting Standards and the Public Financial Management Act 2016 and the Chart of Accounts of Government of Ghana, I, the Statement of Financial Performance of the Consolidated Fund for the year ended 31st December 2022, II, a statement of financial position of the consolidated fund as at 31st December 2022. So for 17 marks, we are preparing the statement of financial performance, statement of financial position of the consolidated fund. So that means we are on the central government perspective. And if we are on the central government perspective, then the sources of revenue to the central government, if you remember your discussion under revenue management and expenditure control, will be to talk about direct taxes. So we're going to be classifying the revenue items into direct taxes, number one, and then indirect taxes, number two. Then we're going to have non-tax revenue, number three, and then the last one is going to be grants and donations, number four. So these are the things that we must understand when it comes to the revenue classification as per the chart of accounts of the Republic of Ghana on the central government, that is preparing the financial statement of the consolidated fund. On the expenditure side of things, or the expenses side of things, we're going to be having the usual compensation of employees, goods and services, public debt interest, social benefit, grants, because government sometimes, the central government gives grants to the covered entities, and that will be an expenditure as well in that case. Then subsidies and others. All these are the expenses or the expenditure aspect we must understand when it comes to the statement of financial performance. So let's get excited, and we're going to be starting with our workings. And so since we are preparing statements of financial performance and position, I could set out some workings here. So workings one, maybe direct taxes. Let's see, are we working 3 zeros up or something like that? We're working in million up. So you got to be mindful of that. So direct taxes, if you're going to work like this, which you will, in the exam hall, you want to make sure you are leaving reasonable space to be able to work yourself out. So indirect taxes will be my workings 2. I'll go to workings 3 to be non-tax revenue. At least these 3 guys will be usual things when it comes to the revenue side of things there. Then we can go to workings 4, grants and donations. That is also coming up in million. Then the expenses will come, workings 5, compensation of employees. So compensations or compensation of employees. So we bring that up. Then working 6, goods and services. Then others will come up as we proceed in the discussion. Again, if you are going to be working like this, which you will, make sure you leave reasonable space so you can work well. So make sure you are leaving reasonable space so you can work well generally at the end of the day. So let's see what we have, and let's go back into the preamble of the question. The following trial balance was extracted from the records of the consolidated fund for the year ended 31st December 2022. Okay. Remember, as always, if we are giving trial balance like this, it's a good news because on the debit side, we could have assets, we could have expenses, okay, on the debit side. Then the credit side will be income, liability, provisions, which is also a liability though at the end of the day. So very important. So anything on the debit side, we know it's an asset or could be an expenses. Anything on the credit side, we know can be an income or liability or provisions there. So let's begin the journey. The first thing we see is corporate taxes. Okay. Corporate tax are tax paid by companies, right? So that is a direct tax, DT. Then personal income tax. That could form part of PAYE. So that is also a direct tax. So those two guys will be going under my flow for direct taxes. Permit me to go this way. So I can keep my slide a little bit cleaner. You're going to write, I'm going to pick things up and go away. So direct taxes, these two will come under direct taxes. This is going to require speed and accuracy a lot because of the way the question will be structured always. Next, taxes on general goods and services. Okay, that's indirect tax. Import duties, that's indirect tax. Export duties, that's indirect tax. Then the next item is capital gain and other taxes. That's a direct tax. So let's go into direct tax. I got to write that up. So capital gain and what is the name there? Other taxes. And the amount there is the due 6,000. So let's bring the indirect taxes here quickly on that. So the indirect taxes, there are 3 of them. So we pick it up there and put it under my indirect taxes. There we go. So these are all indirect taxes. Taxes on general goods, import duties, export duties. These are indirect taxes, okay? Then the capital gains is a direct tax, okay? Because capital gains tax is taxes that you pay when you sell capital or other permanent assets of permanent nature generally, or even shares if the shares are not listed on the stock on the Ghana Stock Exchange. So those are indirect, so those are direct taxes. Let's proceed. So you realize that so far everything we are picking are on the credit, the things we are picking are on the credit side. And so they are all income related issues, right? Revenue related issues. Next one, communication service tax. Okay, that's an indirect tax. So we go to indirect tax, communication service. So when you buy internet data or bundle, or you buy airtime, you are paying for this tax, 23,000. So it's not like when you buy data or when you buy airtime, all the money is going into the government, to the service providers. Some of the money goes to the entity in respect of, how do we call it? Oh, some of them go to the government because it's a form of tax. Next one, royalties. Ooh, royalties. That's not a tax revenue because it's not a direct tax, it's not an indirect tax. So that is a non-tax revenue. Okay? Fees and charges, non-tax revenue. Investment income, non-tax revenue. Right? So these 3 guys will go to non-tax revenue. So let me bring them up in my slide. Easy peasy. So non-tax revenue There we go. These are all non-tax revenue. Next one, grants. Okay. But you got to be careful here because there is grant on the debit side, there is grant on the credit side. So certainly the one on the debit side is an expense because remember we established earlier that the things on the debit side could be an asset or an expense. So the grant on the debit side is an expense. We're going to be bringing it into the statement of financial performance. Then the one on the credit side is an income. If there are no other information, then we'll bring that directly on the face of the financial statement. So we'll come back to that later as we proceed in the discussion. Then we continue. Established position salaries. Okay. That's compensation of employees. Casual labor, compensation of employees. Travel allowance. Travel allowance. That is still payment to employees. Then transport and support. That will be goods and services. So that last three must come under goods, compensation of employees, because they are all payments we made to the employees of the entity. So that is compensation of employees. There we go. Next, travel and transport. That relates to the day-to-day running of government machinery. Then, utilities. Also relating to running of government machinery. Utility allowance. Also relating to that in that case. Now, utility allowance, you got to be careful about that because that could be an allowance that the government is giving to employees, right? So that will not come under goods and services. We're going to put that under compensation of employees because utility allowance will be part of the payment package to the employees in the public sector. So let me go this way. So you see that some of the things have been, so utility allowance. That is an amount of 2,500. Like this. So under goods and services, we will have the first two. Travel and transport, then utilities that are paid. You know, utilities very crucial, right? There was a time in this country under the previous administration when the Electricity Company of Ghana went to Parliament to turn off the lights in Parliament. And the then managing director was asked, and it was that Parliament was working, and it was like, yeah, he was also working. Such level of, political tug of war. Quite an interesting times we've been in this country. Next one, training and seminars and conference. So that's part of the day-to-day administration of government. One of the useless things that we do in this part of the world that has no bearing on economic development sometimes. Printing, materials, and stationery. That will be part of goods and services. So let's bring those two up. So let's see. Let me pull it up here. There we go. Good. Next one. You can see, what did I just bring? Okay, training and, okay. Next one is car maintenance allowance. That is also compensation to employees. Okay? So car maintenance allowance. Your problem usually in the accounts preparation will be the classification of the items. Because if you're not able to appropriately classify the items, then you're going to be in trouble. Okay, 650. And I always tell my students this, that in that case, your net operating results, which is the final answer, will be correct, but everything else, the individual takes will be wrong, and that is really bunkers at the end of the day. Then next one, interest on domestic debt, interest on external debt. Okay, so let's add the two up to give us public debts interest. So working 7, public debt interest. So we bring it up. There we go. We're going to be adding the 2 up, subject to any outstanding which may be in the notes, which we will get into later. Next, domestic debt, external debt. So these are the debt outstanding so far. We'll come back to that because that will go directly on the face of the statement of financial position. Again, subject to anything that may happen in the notes as we proceed. Payables. Okay, for now, we're not going to touch that as well. Receivables. Again, we're not going to touch that as well because if there are certain things in the notes, then we could talk about them. Next one, motor vehicle, land and building, furniture. All those are non-financial assets that we have to work for. So workings 8, non-financial assets, or sometimes can be called infrastructure, property, plant, and equipment. So non-financial asset, we have motor vehicle, we have land and building, we have furniture. So motor vehicle, land and building, then furniture. Okay. There we go. As always, I could see if I have total column here. We are working in million up. So if you check, the figures on the debit side are the costs. The figures on the credit side are the accumulated depreciation brought forward. Okay? So let me take them out like this. And then see what we have. So let me zoom out a little bit. So we bring in the cost. 320,000, 900,000, and then 250,000. Then we're going to less the depreciation brought forward. Accumulated depreciation brought forward, which will be the ones on the credit side. 120,000 here. 290,000 there, and then 42,000, so that we can get a brought forward, or if you want, carry down, or net book value at the beginning of the year, or balance brought forward. Let me write the right one. carrying amount brought forward. So this is going to be 200,000. Then 900, 290. That's 610. And then this will be 208,000. So that is the carry down or carrying amount of the asset at the beginning of the year. We'll come back to them in a moment. But that is what we use that figure to do. Next, long-term investment. That's a non-current asset, intangible non-current asset. So we'll bring it up later in the discussion. Cash and cash equivalent will come. Subsidies, we will bring it. Social benefit, we will bring it. Other expenses, we will bring it. So those are going to be direct line items that we are going to be bringing on the face of the financial statement. Are you getting it? Direct line items that we will bring on the face of the financial statement. So let's go. Then accumulated fund. Be careful here because the accumulated fund is on the credit side, which is a positive figure. Because as you know already, in the public sector, we don't have equity. We don't have retained earnings. So in the public sector, the accumulated fund becomes like your retained earnings over the period, right? And you expect it to always have a credit balance, which is positive. If it was having a debit balance, it would have been negative. But that would be the opening balance of the accumulated fund, and we'll come back to it later as we proceed. So those are the trial balance. The grant, we have not touched it. We'll come back to it. External debt, domestic debt, financial statement position, subject to any changes that may apply. Long-term investment, we've not touched it. We'll come back to it, subject to anything that will apply. Subsidies will come as a line item. Social benefit will come as a line item. Other expenses will come also as a line item. So these are the things we must understand generically when it comes to these issues here. So let's go to the additional information. Okay, so again, you realize that the way I work as always is you read and you work. Okay, you read and you work. And once you know what you are about, based on the context of the question, I'm in the central government. So my revenue classification as per the chart of accounts should follow this. I'm in the expenses environment. So my expenses as per the chart of account should be like this. That is what will then guide you to be able to work yourself out. So let's go into the additional information and let's see what we have on the additional or in the additional information. 1. The financial statements are prepared in accordance with International Public Sector Accounting Standards, the Public Financial Management Act 2016, Act 921, and the Chart of Accounts of Government of Ghana. Okay, that's usual, that's normal, so we get it. Let's proceed. Note 2. 50% of grants received relates to a social safety network program sponsored by donor partnership. The condition of the grant is to ensure full implementation of the program. Even though the grant has been received by government, the program is yet to be implemented fully. The transaction should be accounted for in line with IPSAS 23, revenue from non-exchange transactions. Okay. Okay. And that was what I was telling you earlier, that when it comes to the preparation of the financial statement, IPSAS 23, IPSAS 9, those revenue standards will be coming in. Now remember that these IPSAS, this is your last time of seeing them, because from next year, effective January 2026, IPSAS 48 is coming to town, and the IPSAS 48 is going to replace 3 different IPSAS. So the IPSAS 48 will replace IPSAS 23, revenue from non-exchange transaction. IPSAS 9, revenue from exchange transaction, and IPSAS 11, construction contract. So the IPSAS 48 is going to consolidate these three IPSAS. It's just like in the private sector where IFRS 15, revenue from contract with customers, came in to replace IAS 18 revenue and IAS 11 construction contract. So that is just current issues, current development that I want you to understand. That going into 2026, from 1st January 2026, these three IPSAS are replaced by a new one, IPSAS 48, and you have to be mindful. The treatment and the issues are almost the same, only that unlike having separate issues, we are going to now integrate them into one single accounting standard. So that is just a way of current issues, current development that you need to understand. Now let's come back to our scenario. So remember we saw grant earlier on the credit side, the 28,000. Now we are being told that, oh, by the way, even though the grant has been received by the government, the program is yet to be fully completed. Okay. So since government has not completed the program, then we cannot recognize the grant. So it must be recognized rather as a deferred income, a liability in the statement of financial position. So what does that mean? It means I need to work for grants. I think I have the workings for grants already here. So we bring in as per trial balance. So as per trial balance, government grants 28,000. So we're going to less the grants received, but we have not done the job yet. Okay, so we less deferred grant because it cannot be recognized as part of the revenue for the year. And that's 50% of 28,000. And that should be 14,000. So the double entry for this is to debit the grant account. That's why we are subtracting it. Then you credit deferred grant account. So we're going to take this 14,000 to the statement of financial position under current liabilities later. Okay. Now, there are two schools of thought that the alternative way is to just add it to your payables, like you owe people. Okay, so it could be added to the payables so that it will come as a line item, or so that we bring payables rather as a line item. Or as I said, we will still have our payables, then we will bring the deferred grant as a line item on the face of the statement of financial position. So it's discretionary when it comes to the treatment and what you must do there. But that is the footnote 2 and what we do in respect of that. So the corresponding entry for the deferred grant, we will enter it on the face of the statement of financial position under current liabilities. Note 3. An amount of 6 million. Now you got to be careful because you are working in million up. It means whatever you are picking in the footnote, you have to cancel 6 zeros. And that is something you have to be mindful of because almost always, sometimes, students have problem with that. So we are going to cancel 6 zeros out and then pick only 6,000 because we are working in million up. So an amount of 6,000 is owed to employees of NAPCO program. And the amount remain unpaid at the end of the year. So that's payable. You know NAPCO, right? Oh God, what a beautiful country we have. We have suffered in this country. We have suffered. So payables. We bring the flow up. So let's bring the trial balance first. So as per trial balance, as per trial balance, How much we got? 129,000. So the payables, the double entry is to its employees, NAPCO employees. So the double entry is to debit the compensation of employees and then credit payables. So we could say salary outstanding. I just want to clarify it a little bit. NAPCO. And that is what? 6,000. Even up to today, these people are still owed by the government. Such a ridiculous environment to be in. Because they were still not paid before the previous administration left. Although that policy was launched and later abolished. You know, that's Ghana for you, right? So that's note 3. We are done. So we are using the accrual basis for the preparation of the financial statement. Now, this is something I want you to understand very well. Because you see, everything we are doing, there are key issues you got to be mindful of. So number 1, I said, when it comes to the financial statement preparation, that question 1 that will come in the exam hall, be mindful of the IPSAS. IPSAS 23, revenue from non-exchange transaction. IPSAS 9, revenue from exchange transaction. IPSAS 17, property, plant, and equipment. IPSAS 12, inventories. IPSAS 19, provisions, right? Then revenue management and expenditure control. But in addition to that, it is important you know the accounting basis that we are using to prepare the financial statements. Here in the question, we are using accrual basis. What does that mean? It means all revenue and expenditure will be recognized, whether we've received it or not. If we are preparing a cash flow statement, then we will recognize only the cash that has been received or paid. That's all. Now, there is also what is called modified accrual basis. Modified accrual basis. In the modified accrual basis, 2 things are happening. We will recognize revenue on cash basis, and then we'll recognize expenditures on accrual basis. So you got to be careful there. That's modified accrual basis. So for instance, if you take the Republic of Ghana, the 2024 financial statement of the Republic of Ghana, the Controller Accountant General claimed that the financial statement of the Republic of Ghana was prepared using the accrual basis of accounting, meaning that revenue and expenditures are recognized whether we've received or not. But the Auditor General's report indicated that there were a lot of expenditure items, a lot of revenue items that were not recognized. A lot of revenue items especially that were not recognized. And that was one of the confrontations between the Auditor General and the Controller Accountant General, because there were a lot of revenue items that should have been recognized in the financial statement of Ghana, but the Controller Accountant General did not recognize them. So technically, what was happening was that although the Controller Accountant General had said the financial statement of Ghana was prepared using the accrual basis of accounting, in the preparation, he was actually using modified accrual basis. In other words, he was recognizing revenue on cash basis and expenditures on accrual basis. And that was a key back and forth between the Auditor General and the Controller Accountant General. So that's very important for you to understand, because if we are using the modified accrual basis to prepare the financial statement, then when we come to the footnote, any revenue outstanding, any revenue due the entity that had not been received yet, we won't bring it in the books. Because under modified accrual basis, revenue is recognized when cash is received. But the expenditures will be recognized on accrual basis, because under the accrual basis, we recognize the expenditures when we undertake the project or when it becomes due or we enjoy the service. So that is something I need you to be mindful of when it comes to that question 1 area. The IPSAS that you have to be mindful of, The issue in respect of revenue management and expenditure control for the classification items. Then the basis of accounting, because that is going to influence the way you work for the notes to the financial statement. Very important. Very important. Okay. So let me go back into my slide here. Note 4. A debt arrangement by the government has resulted in debt forgiveness for the country. You know, we borrowed and 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 borrowed. So they are forgiving us some debt. The external creditors have written off 40% of the debt without conditions. The transaction is yet to be accounted for. Okay. Debt forgiveness is an income. Debt forgiveness is a form of a grant. So you borrow the money, run the country into the ground, use the money to dig holes and things. Then creditors, external creditors said, okay, we give you 40% off. So that's a grant. It's a form of grant we have received. So what's the double entry? The double entry is that you're going to debit the external debt, meaning subtract it from the external debt, and then you credit government grant. That's the idea. You credit government grant. Now, the reason why, if you pay attention, I have also been talking about the journal entry is because in some of the questions, in the question 2 area especially, the examiner may call on us to treat to account for certain things based on the journal entries. So don't just be robotic and say, hey, I'm going to deduct it. Can you talk about the journal entries as well? Because you're an accounting student. Public sector now is not just public sector issues. It's a pure accounting thing that you must understand. So let's go. External debt. In the trial balance, the external debt was this 520,000. As you can see there. So they are forgiving us 40% of that. So we go to the grant and then we add that there. So debt forgiveness. So 40% of the external debt, 520,000. So 0.4 by 520. And that is 208,000. So it means if we now go to the statement of financial position, external debts, could do that quickly here. I could do it on the face of the financial statement, but just permit me to just put it here. So external debt, because sometimes you don't have a lot of time to do a lot of workings. So we could actually do this on the face of the financial position. So as per trial balance, 520. Then we less the debt forgiveness. Let me just pick this and copy it. So debt forgiveness is a form of grant. Okay? It's an income and it's a form of grant. It means the people you owe are saying, hey, it's okay. Use the money to build yourself up because you borrowed the money and then you ran the country into the ground. But we believe in you. Use the money to restore yourself to profitable era. That's the idea there. So that's what we must understand there. Note 4. Now, again, they said this had not been accounted for. That's why we are now incorporating it into the books. Very important there. Okay. Note 5. Note 5 says, the following inventory exists at the end of the year. Immediately I hear inventory, it means that I am going to be calling on IPSAS 12 inventories. What's the principle under IPSAS 12? Simple. If the entity has an inventory and it is an inventory that they're going to use in the day-to-day running of the organization, or an inventory that they are not selling because they will distribute it for free, then the inventory will be carried at lower of cost and the replacement cost. However, if the entity has an inventory that it will sell, it is for sale, then the inventory is carried at lower of cost and net realizable value. So that's the principle. So let's go back into the inventory. 1, it says printing material. Stay with me carefully, into bracket, not for sale. So if it is not for sale, it means they use it in the day-to-day running of the entity or government machinery. So what will be the basis? It will be the lower of cost and replacement cost. The lower of cost and replacement cost. So the cost is 200, the replacement cost is 195. So it means we will carry it at the replacement cost. Now, so that is closing stock. It will come under goods and services. Because remember, in goods and services, you brought printing material and stationery, the whole 1,000. So now that there is a closing stock, you must less it. So we less closing inventory, printing material, how much we got? 195. So lower of cost and replacement cost. It means when we go to the statement of financial position, this will be the inventory that will go there. 195. Are you getting the picture? Next one. Office consumables. Also not for sale. Okay. It means we would use lower of cost and net realizable value. But, sorry, lower of cost and replacement cost. Now, that one, the cost is lower, 50. So we'll use the cost rather there. So office consumables, 50. All right? That's the idea there. So you realize that in the context of this question, the net realizable value is not needed. But the examiner brought it. It's not that the examiner wants to confuse you. No. The examiner just wants to find out, do you know IPSAS 12? If the inventories are not for sale, then it is carried at lower of cost and replacement cost. So it's not like, oh, the examiner brought a thing, we didn't need it. It's an exam. So what do you expect? Now, so our closing inventory will be in total the 50 plus the 195, and that will go on the face of the statement of financial position. So 50 plus 195, I could do that, 245. So on the statement of financial position, under current asset, 245, that is what will go there. So that is IPSAS 12, note 5. That's what you need to understand. And in almost every final account preparation, there is a high probability that you're going to call on IPSAS 12. So you got to be careful to know, should I carry it at lower of cost and net realizable value, or should I carry it at lower of cost and replacement cost? Principles, very important there. Next, note 6. Consumption of fixed capital for the year are charged on a straight line basis. So there we go with our IPSAS 17, property, plant, and equipment. Now, if they are charged on straight line basis, it means they are charged on the cost of the asset. You know this from KG2. So it means your depreciation is going to be the cost of the asset minus any residual value or scrap value divided by the economic useful life of the asset. Straight line method. No miracle there. So let's go. So motor vehicle, 5 years. Land and building, 20 years. Furniture, 4 years. So 5, 24. You know, we have that already worked out somewhere. Where is it? Yeah, note 8. So this is 5 years. This is 20 years. And this is 4 years. Did I get that right? 5, 20, and 4. So we will divide. So the cost for motor vehicles will be 320 divided by 5. That's 64,000. So that's going to be the depreciation for the year, or consumption of fixed assets. In the public sector, you will hear more of consumption of fixed assets, but it's the same as depreciation. So consumption of fixed assets. Sometimes you will hear consumption of capital assets. All these are just used interchangeably. So 64,000, we take it out so that we can get a carrying amount at the end of the year that will go on the face of the statement of financial position. So carrying amount at 31st December 2024. Hey, relax. Is it 2024? No, 2022. Okay. So that'll be 136. Building is 20 years. So 900,000 divided by 20 is 45,000. 45,000 minus 610. That should be 565,000. Then the last one, furniture, we are doing 4 years. So 250 divided by 4. That's 62,500. $62,500. We take it out, and that gives us 145,500. So we need a total depreciation for the year. That's why I brought in the total column. So 64, 45, 62.5, and that is 171,500. So that's our total consumption of fixed assets that will come on the face of the statement of financial position. In some cases, it could be added to the other expenses that we saw in the trial balance, these other expenses. Again, it's a discretionary issue. In some cases, it could be added there, but that is the idea there. So that is footnote 6, consumption of fixed assets, and what we do there. Now, really, almost always, this note may not have a lot of nuances, aside the fact that if there is a prior period error issue, okay, and that is under IPSAS 4, accounting policies, changes in accounting estimates and errors, and then you have to redo the adjustments and then do the reversal in the accumulated fund. Again, I always want you to understand the parallel, the relationship between the two, because in the private sector, under the IFRSs, we have the IPSAS 8, accounting policies, changes in accounting estimates and errors. And if there are prior period errors, you will adjust for them on the opening figures, and if they have any P&L effect, then you will adjust for it in the retained earnings. In public sector, the same issue. So if maybe there were some assets they had bought last year but was not accounted for, then we would have accounted for it and brought it into the workflow. But you have to understand then that the depreciation on that asset would then have to be written off against the accumulated fund brought forward. Are you getting the idea? So these are a little nuances that you have to be mindful of. So we bought an asset last year, but for some reason it was omitted from the records. Then this year we saw it. Okay, it will now be brought into the records, but the depreciation of the assets for last year would have to be written off against the accumulated fund brought forward, because depreciation must be accounted for. So that will be the nuances that the examiner can bring. Then certainly the issue about revaluation of assets, because in some cases, assets may be revalued because the government or the entity may be applying the fair value model and not the cost model for accounting for the asset. And so in that case, then there is going to be revaluation surplus, which would then go to the reserves, and then if there is a revaluation loss, then it will come to the statement of financial performance. So those are the things that you must understand. Certainly not forgetting issues about impairment, IPSAS 21 and IPSAS 26, because in the public sector, when it comes to impairment, it is divided into IPSAS 21, impairment of non-cash generating units, IPSAS 26, impairment of cash generating unit, which in principle is just the same as the impairment you know in IAS 36. So you realize that if you are doing financial reporting and public sector, or public sector and corporate reporting, you're going to be enjoying it a lot, because the IPSAS treatments are just the same in the IFRSs, because the law is the law is the law. The principle is the principle, right? Generally. So those are some little nuances that we must be mindful of when it comes to how we deal with the non-financial assets there. Then the last one, footnote 7, says, due to the current economic condition, the long-term investment of government was impaired by 20%. Ooh. Long-term investment of government was impaired by 20%. Okay. You remember we saw long-term investment earlier, meaning it has fallen in value. So that fall in value, maybe we could write it off against the other expenses item. So let's go in and then maybe note 11. Long-term investment. See how beautiful public sector is? Oh, Nhyira, it's not beautiful. It's not beautiful. Which one is beautiful? If it's not beautiful, then something is under your eyes. Like we say in Ghana here. So we less the impairment. They said it has suffered an impairment of 20%, has been impaired by 20%. So 20% of the 160,000, so 0.2, 160,000, that's 32,000. So that the new figure, which will go on the face of the statement of financial position, will be 128,000. But as I said, this impairment must be recognized in the statement of financial performance. So we could add it to other expenditures in the statement of financial performance. Workings 12. Other expenses. As per trial balance. So the other expenses in the trial balance, how much we got? 26,000. Like this. Then we bring in the impairment in long-term investment. So impairment of long-term investment. Like this. And that is going to be workings 11, 32,000. So again, the double entry is to debit the expenses or debit the statement of financial performance, and then we credit the long-term investment. Okay? We credit the long-term investment. That is the idea in respect of this. Right. So these are the things. It looks like we are done with the notes. So let's see if we can put the pieces together real quick. So the other expenses, let's add it up quickly. 2632, that'll be 58,000. Then let's clean it up. External debt When we less the debt forgiveness, 520 minus 208, that will now be 312,000. Payables, 129 plus 6, 135,000. We finish with non-current assets or non-financial assets. We come to public debts, interest. There were no other nuances, so 63,000. Then we come to goods and services, 14, 8, 10, 1, minus 195. No, I can't do 14. 14,000 rather. 8,000. 10,000. 1,000. 195. 50. And that is 32,755. Okay. Compensation of employees, 83,000. 42,500. 650, 6,000. And that is 132, 150, 132, 150. Give me a sec. I want to see if my arithmetics is right. 63,000, 20,000, 4,000, 25, 650, 6,000. Oh, 96, 110 rather. So my calculator, right? You know I'm still wrong because the calculator is part, or calculation is part of the work. Grants and donations, 28 minus 14 plus 208. That's 222,000. Next one, non-tax revenue, 46, 18, 800, 2,100. That is 25,500. Indirect taxes, 4,200, 44,000, 12,000, 23,000. And that is 119, 200. Then you come to the tax rev, 32,21,6. That's 59,000. That's direct taxes, 59,000. That is the idea about this, and these are the treatments that we need to understand. So again, quickly, when it comes to that question 1, preparation of financial statement, my recommendation as always is that let that be your last but one question. Because of how much time is required when it comes to the financial statement preparation. Okay? So just like in financial reporting or corporate reporting, I would say consolidated financial statement should be your last but one question. That's the same agenda here in public sector. The reason is because it requires a lot of time. So the strategy is that you get to the exam hall, you're going to take your time, read through all the questions. Now, when you take your time to read through all the questions, what you are going to do is to then answer all the written questions that you can answer best first. Question 5, the question 3, all the written questions, comment questions, take them out quickly. Then, depending on how strong you are, you can come to the question 4 area, which is going to be evaluation of financial statements. That could be either we are using common size, or we are using ratios, or we are using budget variance analysis. So if you are strong in that area, you take that 20 marks, boom, out. Then you come to the standards. What is there, what you can do, you take them out. One of the things you must understand is that in that question 2 area, when it comes to the IPSAS, there will be theory questions there. So that question 2 area on the IPSAS is not just calculation. there are theories, IPSAS-related theories that you must know about that the examiner will ask you. So that is a strategy. You want to take out all the theories as fast as possible. You are not under obligation to solve questions in any order. The only thing you have to do is that you're not going to solve two different questions on the same page. In other words, you cannot solve question 2B on the same page as question 5C. No. So each question, just go take out the written part, come to the evaluation of financial statement, go to the standards. So that by the time you are coming to this question 1 area, you have approached about 80% of the exam questions. So that here, you come do something. And if you're able to finish, it's also adds up. Because this is going to require significant amount of time. Very significant amount of time. But if you are strong in your revenue management and expenditure control, you are strong in your standards, you are strong in your ratios, evaluation of financial statement, ratio, PIFA, and those things, you're going to be in the position to pass the examination. Remember also that you can get access to our practice question courses on the other subjects. So financial reporting, corporate reporting, management accounting, and then advanced audit and assurance. You can get access to the practice question courses on our website. So that will give you a walkthrough of detailed questions in all aspects of the syllabus, financial reporting, management accounting, fully available on our website. So you can visit our website, NhyiraPremium.com, and then you'll get access to those practice question videos. That will give you the opportunity to be able to also join our Executive Leadership Masterclass that is starting today's week. So today's week, we are starting with our Executive Leadership Masterclass. It's a 2-week masterclass that we do, spending time with our students, walking through the syllabus, providing them the guidelines that they need, and fine-tuning their understanding so they can go into the exam hall, write the exam with confidence, and pass the examination. So you can enroll in our full courses or the practice question courses, and you'll be in the position to go into the exam hall and pass the examination. So certainly after working all of these out, slide 1 here for the workings, slide 2 for workings 3 and 4, slide 3 for compensation and goods and services, slide 4, public debt interest and the non-financial assets. Slide 5, payable external debt, long-term investment. And certainly the slide 6, other expenses. Now, once you're able to apply the IPSAS, apply the classification rules, the preparation of the main financial statement will no longer be an issue that you have to fight for. So I'm not going to prepare that, but I'm just going to walk you through the financial statement preparation answer here, as you can see here. So under the revenue, in the statement of financial performance, under the revenue, permit me, let's see if I can do a window show here. Yup, I could. No, I'm not looking for you. And then you. Okay, so like this. So I'm going to show you side by side so that I can save some time on that. So direct taxes, if you remember from our workflow here, workings 1, direct taxes, we got 59, okay, thousand, and that's what you are seeing here, 59,000. Indirect taxes, we got 119 in our workflow, okay, 119,200. That's what you are seeing there. Then non-tax revenue, that was workings 3. We got 25,500. That's what you are seeing there. Grants, That's workings for. We got 222,000, right? That's what you are seeing there. And so that's our total revenue. Then the expenditure side of things, you come to compensation. We got 96,150. That's what you are seeing there in the solution, 96,150, and all of the expenditure items. So at the end of the day, you are seeing that there was a deficit here in the workflow, and you do your final workings, which is on the accumulated fund. Then on the statement of financial position side of things, the property, plant, and equipment, the workings we did on non-financial assets. So the three could be added up, and that will give you the figure. Long-term investment, after the impairment that we calculated for, we were left with 128,000. So that is there. Inventories, when we add the two up, we got 245. Receivables come, cash and cash equivalent, and that is the idea about that. And note, all of these for 17 marks. Okay? Because what we've done is 17 marks. So 1.8 times 17, that is 31 minutes. So you are supposed to use 31 minutes approximately for this. And that is why the strategy is build your knowledge base well, to the extent that you don't have to think a lot in the exam hall. You know how to classify things. Then even the punching is going to be an issue. I tell my students all the time, the calculation. Because some people are not familiar with the calculator, and, they are slow people. Oh, Nhyira, I'm a slow puncher. I'm a slow this. Listen, if you are slow, you're going to be last every time. You go chop last. So you got to familiarize yourself even with the calculator and the punching generally. Then the B aspect, which is for 3 marks, is discuss 2 disadvantages of classifying expenses by function in the preparation of financial statement. So if we decide to classify expenditures by function, what are the advantages, not disadvantages? That's useful, right? Because if we are classifying expenditures by functions like compensation, like goods and services, like social benefit, like utility reliefs, right? Like public debt interest. You are classifying expenditures according to function. So what are some of the points here? Let me just go there and then discuss some of the points that were mentioned there for you. 1, it provides useful information about the major functions of government. So when I see compensation of employees, okay, I know that is how much money government is paying on employees. When I see goods and services, I'm like, oh, this is how much money government is using to run the machinery of government. When I see public debt interest, I see that, oh, this is how much government is paying on interest. Now, that is not debt servicing, because debt servicing has 2 components, the interest and then the capital repayment. So this is just the interest. How about the capital repayment? Then certainly those things. So that's one thing. It's useful information. It reveals the functional priority of the government. Yeah? Because at the end of the day, we're able to know, okay, where government is spending more money could be concluded as the area that government is prioritizing more on. So if you check this question, for instance, and we go back to the trial balance of this question, look at something like subsidies. How much subsidy is the government giving? 1,200. Compare that subsidies the government is giving to come to the compensation of employees. Look. Compensation. Look at goods and services. Look at travel and transport alone. Renting of private jets and other useless expenditures we incur in this part of the world. Right? So you sit down and you ask yourself, we spent, now this is 14 billion Ghana cedis. Travel and transport, right? Then you look at social benefit or subsidies, relief that you give to the citizens. Look at the miserable amount of money we are spending. So again, it tells you what government priorities are. Like they would like to travel in private jets and then go around the country or around the world without adding any significant value to the economy of the country. That's the thing. And then the underlining things like social benefits and subsidies, which will provide the relief to the citizens, they will not do much of that. So classifying the expenditures into the functions gives us that picture. So at the end of the day, the social benefits will not come. Subsidies, they will remove all the subsidies. Then they will come and give you haircuts on top of it because they are not able to pay for money that they have taken from you. That is the idea. So it helps us a lot to have that understanding on the government. Then certainly the last point will be the users are likely to understand expenditure classified by function, such as education, and health than other classified by nature, such as compensation for employees. So if there is a better classification according to the major functions of government, there will be a better understanding in respect of the expenditure. So at the end of the day, we know, okay, the whole of education, what's the government expenditure on that? For instance, something that is in this country that I speak about all the time, the payment of allowances, okay? Nursing training allowance and teacher training allowance. One of the dumbest and useless expenditures that government spends. And to my surprise, unless otherwise I am wrong, in 2025, the government of Ghana's budget, the money that government is spending on teacher training allowance is about 480 million Ghana cedis. Teacher training allowance. That is, if the data I have is right. Nursing training allowance, about 480 million Ghana cedis. Find out what is the capex for the health sector, the whole of 2025. It's around 430 million Ghana cedis. So the capital expenditure, the hospitals, the CHIP compound, the clinics, and all the things that will employ the nurses and the health workers when they graduate, we are spending just 430 on it. Then the allowances, and one useless expenditure like that in this part of the world, because, you know, why do you pay teacher training allowance? Why do you have to pay teacher training allowance? Then the people finish the school, you cannot post them because you don't have money to pay for their salaries. Or there are no health facilities available enough to absorb them. So, you know, it's something that I don't know why government continues to pay that. To me, it's something government has to stop. Because that 480 million Ghana cedis every year could build on an average a modern CHIP compound, about 710 CHIP compounds every year. Now, imagine you are going to school and government is constructing health facilities every year like this. It means when you finish school, you get a job. Rather than finish school, you will demonstrate for posting. They finish posting you. You will demonstrate for your salary. So as a health worker, as a teacher, your whole life is all about demonstration. And that is sometimes, if you think about the whole thing and ask yourself, why in our part of the world, some of these things are still going on? Paying teacher training allowance, paying nursing allowances. It's absolute, ridiculous in my opinion that we continue to have that when there are still schools under trees. You don't have to pay somebody to go to school. If they don't want to go, they should be there. Do we pay people to be lawyers? Do we pay people to be chartered accountants? Do we pay people to be engineers? No. So, I don't know. And it's only Ghana that does this. Around the world, you don't see these things there. But that's Ghana for us at the end of the day. So, these are some of the things generically that we have to understand when it comes to public sector. And you see that throughout my discussion, I am bringing you those issues, practical cases, because that's public sector. Everything you are studying is happening right around you. So your ability to be able to familiarize yourself with the current issues, current affairs going on, they will help you to really appreciate the syllabus so you will not study and be abstract from the syllabus at the end of the day. These are the things you must understand when it comes to the preparation of the financial statement for public sector accounting and finance. So the key takeaway here is be strong in your IPSAS, be strong in revenue management and expenditure control, certainly. Very important. Then understand the accounting basis, cash basis, accrual basis, modified cash basis, modified accrual basis. All those will determine the way the financial statements are going to be prepared. So make sure you understand them very well. And if you can do that, you put yourself in the position to go into the exam hall, write the exam with confidence, and most importantly, pass the examination. So that's it about that. Thanks for watching. And I'm going to come again on Wednesday at 4:30 p.m. and we'll continue with our discussion. Again, if you want more practice questions like this, you can visit our website, NhyiraPremium.com, and enroll in some of our practice question courses, because that gives you access to the full practice question courses. Then you can go there and then go through the program well. That gives you the opportunity to also join our Executive Vision Masterclass, which is going to be starting next week, Monday. Exactly today's week, 20th of October. And let's see how we can assist you so you can prepare well for the examination. Take care of yourself, and I will see you on Wednesday as we continue with our discussion. Bye-bye.